Guys, I have a confession to make before we start with this video. I've done terrible mistakes in the stock market as a beginner and I have lost a good deal of money due to it. Wait, then why am I even eligible to give you gyan about the market? Why should you listen to a loser? Well, first things first, after burning both my hands as a beginner, I took up a few paid courses and learned about the market. I was fortunate enough to recover from my losses soon, and the journey has been onwards and upwards from the last 3 years. See, a winner can tell you what to do, but only someone who has lost money can tell you what not to do in the market. Money is precious, and I don't want anyone to do the same mistakes that I did in the first place. So, this chapter would be all about realizing the silly mistakes that a beginner can do. So, let's start with our video. Trap number 1, following the news to invest. Following stock recommendation from Anil Singhvi to Ashwini Gujral, from G News to CNBC, these people just provide stock tips with stop loss and targets. And with each week, they come with different stock names. But once I started tracking their recommendations in an Excel sheet, I realized that most of them doesn't even work. And even if some work, before even we take the trade, the target would be hit. Above all, it did not help me in my learning curve. I needed to learn. I needed to learn how to select a stock. I needed to learn what are the rules for entry and exit of stock. How much is too much? What should be the number of quantity that one should buy? Where do I keep the stop loss? How many stocks one should be investing into practically? And I was not able to learn any of these since I was bluntly following stock recommendations from TV experts. And not just the learning. Initially, I thought these people at least think of our welfare, but I hardly agree with that anymore. Last year, SEBI banned Hemant Ghai of CNBC Awaz from recommending stocks. He used to buy stocks first and then recommend it on his Stock 2020 show the next morning and then sell it on the same day. He made 3 crore profit till May 2020, looting thousands of innocent retail investors. So, moral of the story, don't make your financial decisions based on what you see on TV and social media. Trap number 2, trading based on news. After coming out of trap number 1, I realized there is no use in watching TV experts. Let me become my own expert. So I decided to watch breaking news or scan for all important news in economic times to check for hot sectors or stocks that are available in the news. I started shortlisting such stocks. Now, if I see quarterly results of any stocks and if the news is good, by default, my mind thinks I should buy it. And as soon as the market opens, I just buy and burn the fingers. Because most of the time, what happened was stocks with even good quarterly results tend to move down in the short term after a big gap up opening. Similarly, after bad quarterly results, stocks that open with big gap down could move up. This is not true in all cases, but you can just never predict how the market would react. Learn this only after losing money. Trap number 3. इससे सस्ता क्या ही मिलेगा यार? So buying cheap stocks in the hope of becoming a multi-bagger someday. What you must have noticed is that most people are more interested in stocks that are trading cheap as it takes lower investments and may give sharp returns in short span of time, or to become a multi-bagger maybe someday. And who doesn't love fast returns? But what most of us forget that cheap stocks gets cheaper and can fade away our investments in equally fast time. PC Jewelers, Reliance Communications, Jet Airways, Vodafone Idea are some of the stocks that people started buying on every dip, thinking they were getting them at good bargains, but they failed to understand that it's trading cheap for a very wrong reason. Stocks like these, which are on the turnaround stories, are at risk. You have to invest when the turnaround is actually real. If you get in at the wrong time, you can lose your entire capital. Always remember, this is not investment. This is pure gambling. Jet Airways, as I told you, is one such example. Whenever the news of a new investor comes in, the stock shoots up, and when the news turns out to be fake, the stock comes down. See, there are reasons as to why this stock is not doing well. It's a bankrupt company. They have piled on more debt than they can handle in the first place. And if someone comes to invest in them or acquire them, they have to clear a significant amount of debt before they can start flying again. All those assets which were there with the company, they all don't exist anymore. It's a dead company now. Remember, reviving a dead company is as difficult as starting a new one. So it is unlikely that the right amount of returns can be made on this. Now, what can we do to avoid such mistakes? Well, the answer to that is simple. Evaluate the business and understand its fundamentals. Always remember nothing comes without a price. So just don't blindly buy stocks that are cheap, as it may get cheaper and wipe off your investment before you even realize that you made a bad choice. Now, before we move to the fourth trap, let's understand the concept of sunk cost. What is the sunk cost trap? The sunk cost trap refers to a tendency for people to irrationally continue to follow through an activity or an investment that is not worth completing. This is due to the time and the money that they have already invested into it. The sunk cost traps explains why people finish movies they're not enjoying. Why do they finish meals that taste bad? Why do they keep in relationships that are not worth their time? Why do they keep clothes in their closet that they've never worn? Why do they keep and hold on to investments that are underperforming? So you might have guessed by now that trap number 4 is all about holding on to your losses in the hopes of a turnaround. See, it's very difficult for all of us to accept losses, right? We keep on holding on the stocks with negative returns, thinking that one day it will bounce back, or at least it would return our initial investments. But unfortunately, in most of the cases, that day never comes. Many beginners follow a simple rule. They sell the winners and hang on to the loser stocks. Now, this is a complete wrong approach. In this way, not only we are limiting our profits, but we are also holding on to losses that can further harm our portfolio. So, if you do not want to lose your hard-earned money, start using just the opposite approach. Limit your lower level and maximize your upper level. Number 5. Bhed Chal. Being an Indian, I assume you know that what I'm talking about. We always have heard many people saying, भाई ये वाला स्टॉक ले ले, इसमें अभी XYZ आदमी ने स्टेक लिया है, पक्का ये स्टॉक भागेगा. And the interesting fact is, many of us do actually buy them. But does it really work? Well, in maximum cases, it doesn't. Now, these people can be your family, friends, or maybe a stranger on an investment forum. But this is borrowed conviction. It doesn't help in wealth creation. Let's understand this with the help of an example. Raju bought stock A after doing research at rupees 100. Arvind now bought the same stock because it is a high conviction bet of his friend Raju. Now the stock price dips to rupees 50. Raju added a few more of that stock, but Arvind sold in panic. After 3 years, the stock price increased to rupees 500 and Raju sold the stocks happily. Now the names are obviously fictional, but the story isn't. This is something which is very common in the stock market. Now some people say I don't follow my poor friends. I follow only big investors. And now this is again bullshit. We have no idea about their entry and exit points and their stocks quantity. So just following what Warren Buffett or maybe Rakesh Jhunjhunwala is doing blindly, you are actually at a disadvantage. You can only buy after he buys and you won't even know when he exited the stock. You will probably know it after 2 to 3 months. So you cannot really model what these guys do in the first place. And even these people are not God. They have also made mistakes. Last year, there were 9 stocks that Rakesh Jhunjhunwala had made significant losses in. He invested 3 crores in JP Associates in 2018 and lost more than 50% of his capital. So always ask yourself this question. Can I trust someone else's decisions? Maybe they are investing with a time horizon of 20 years and they're not concerned about short-term volatility or fluctuations. But you, on the other hand, have a time horizon of 2 years. So you cannot simply copy someone's portfolio. So what we can do now? Is cloning always a bad idea? No, it isn't. But we have to understand the company's fundamentals, its financial reports, and figure out why is it in the news so much. And after studying the company completely, if we are satisfied, then only invest. Never invest blindly following the crowd. See, being a good investor is all about knowing that when you have a loss, you get out of it and you make another investment which hopefully is profitable. At the end of the day, you want to make more profits than losses. It's not that you want to do like zero losses, right? There hasn't been an investor who has never made a loss. It's just that when pluses and minuses sum up, you want to have more pluses, right? So you can do that only if you restrict your minuses and so that they don't go beyond. So, summarizing what we learned today, never invest following news experts or on the basis of some news. Number two, never invest into penny stocks without understanding the fundamentals of a business. You don't want your money to turn into a big zero. Number three, strict your stop losses. Number four, never follow anyone blindly in the market. Do your own homework. Now, as always, I'd like to end this video by giving you a call to action. Go on Google and search about historical share prices of the companies that I have told you about. PC Jewelers, Reliance Communications, Jet Airways, Vodafone Idea. It would be enough to make you understand that the stock market is nothing less than a minefield if not understood properly. So that's it guys, hit the like button if you liked the video and subscribe to our channel as well. So basically this video is a part of the basic stock market course that we have created. You can click on the I button to watch our other videos as well. So thank you for watching the video. This is Srijan Varnwal signing off. Until we meet again.